Unit 6 chapter, the whole thing.
Introduction to Appraisal. Appraisal defined. An appraisal is an opinion of value. An appraisal report is defined in Florida statute as an oral or written communication of an appraisal relating to the nature, quality, value, or utility of a specified interest in real property. The appraisal report communicates the appraisal analysis, opinion, or conclusion of value. If the appraisal report concerns a federally related transaction, the appraisal report must be written. Federally related transactions are discussed later in this unit. Purpose of an appraisal. The first step in the valuation process is to identify the problem. This step sets the parameters of the appraisal assignment. The appraiser identifies the purpose of the appraisal, the client and intended users of the appraisal, and how the appraisal report will be used. The intended use of the appraisal assignment. The overall purpose of an appraisal is twofold. 1. To determine how to go about conducting the appraisal based on the needs of the client. USPAP refers to this as identifying the problem to be solved. And 2. To determine the type of value that is to be estimated. The appraiser must be a good listener to determine the needs of the client. Identifying the problem to be solved guides the appraiser in determining how to tackle the appraisal assignment. The type of value to be estimated is an important consideration to understanding the purpose of the appraisal assignment. There are many types of value, each of which will result in a different value estimate. The most common type of appraisal assignment is the development of an opinion of market value. To understand the purpose of an appraisal, let's review important appraisal terminology. The client is the party who contracts with an appraiser for the performance of appraisal services. The intended use of the appraisal concerns how the appraisal report will be used, based on communication with the client at the time of the assignment. For example, is the intended use of the appraisal for mortgage loan underwriting, to assist the buyer with a purchasing decision, to assist the seller with establishing a selling price, portfolio analysis, estate tax, establishing the IRS tax basis, short sale evaluation, and so forth. The intended user is the client and any other party, identified by name or type, as users of the appraisal report. Who will be considered the intended user is based on communication with the client at the time of the assignment. Relationship between licensed brokers and professional appraisers. Chapter 475, Part 1, pertains to real estate brokers, broker associates, sales associates, and real estate instructors and schools. Under Part 1, appraising is included in the definition of real estate services that brokers may perform. See Section 475.01, FS. Therefore, licensed real estate brokers, broker associates, and sales associates can perform appraisals for compensation. They may not, however, represent themselves as certified or licensed appraisers unless they hold such certifications or licenses. Real estate licensees are limited to conducting appraisals of real property that do not require a state-certified or licensed appraiser, provided they abide by the Uniform Standards of Professional Appraisal Practice, USPAP. Chapter 475, FS, empowers the Florida Real Estate Commission to discipline brokers, broker associates, and sales associates who violate any of the standards or any other provisions of USPAP. Disciplinary Guidelines 475.25. 1. T. Violated the Uniform Standards of Professional Appraisal Practice as defined in S. 475.611. FS. First violation, $250 to $1,000 administrative fine and 30-day suspension to revocation. Second and subsequent violations, $1,000 to $5,000 administrative fine and suspension to revocation. Reference 61J2 to 24.001. FAC Chapter 475, Part 2, pertains to real estate appraisers and sets forth the requirements for licensed and certified appraisers according to federal statute. The Florida Real Estate Appraisal Board, FREB, is charged with enforcing Chapter 475, Part 2. The FREB functions very similarly to the Florida Real Estate Commission FREC. Both quasi-judicial bodies follow the same procedures for disciplining licensees. The rules of the FREB are codified in Chapter 61J1 of the Florida Administrative Code, FAC. FREC rules are found in Chapter 61J2 of the Code. The Department of Business and Professional Regulation, DBPR, licenses and certifies appraisers. The Division of Real Estate, DRE, provides support services to the FREC and the FREB. federal regulation. Several factors collided into a severe financial episode commonly known as the savings and loan crisis. During this period, hundreds of savings and loans either failed or were consolidated with banks. The financial crisis cost taxpayers billions of dollars in a government bailout of the industry. Congress passed legislation to increase government regulation of financial institutions and of the appraisal industry. Title I of the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIRREA, brought the appraisal industry under federal oversight and mandated states to license and certify appraisers. Congress enacted FIRREA in response to the financial savings and loan crisis of the 1980s. FIRREA authorized the Appraisal Foundation as the source within the appraisal profession for the promotion of uniform appraisal standards and minimum appraiser qualification criteria. FIRREA also authorized states to establish appraiser regulatory programs to ensure effective supervision of certified and licensed appraisers. The foundation is a non-member nonprofit organization that accomplishes its mandate through the work of its two independent boards, Appraiser Qualifications Board, AQB. The AQB establishes the qualifications for state licensing, certification, and recertification of appraisers. FIRREA mandates that all state-certified appraisers must meet the minimum education, experience, continuing education, and examination requirements promulgated by the AQB, Appraisal Standards Board, ASB. The ASB sets forth the rules for developing an appraisal and reporting the results. In addition, the ASB promotes the use, understanding, and enforcement of the Uniform Standards of Professional Appraisal Practice, USPAP. Standards of Practice. USPAP is a set of guidelines, standards of practice, to follow in providing appraisal services. USPAP is the accepted standard for valuing real property, personal property, business opportunities, and mass appraisal, the valuing of a group of properties. The ASB develops, interprets, and amends USPAP on behalf of the appraisal industry. Federally related transactions. FIRREA requires state-certified appraisers and licensed appraisers to comply with USPAP standards when conducting appraisal assignments for federally related transactions. A federally related transaction is any real estate-related financial transaction that a federal financial institutions regulatory agency, FFIRA, has either contracted for, or regulates, and requires the services of an appraiser. There are 5 federal financial regulatory agencies: the Office of Thrift Supervision, ODS, the Office of the Comptroller of the Currency, OCC, the Board of Governors of the Federal Reserve System, FRB, the Federal Deposit Insurance Corporation, FDIC, and the National Credit Union Administration, NCUA. A real estate-related financial transaction is any transaction involving the sale, lease, purchase, investment in, or exchange of real property, including interests in property, or the financing thereof, or refinancing of real property or interests in real property, or use of real property or interests in property as security for a loan or investment, including mortgage-backed securities. Real estate licensees are cautioned that just because a transaction is not a federally related transaction does not mean that real estate licensees are allowed to provide the appraisal services. Federal Housing Administration, FHA, and Veterans Affairs VA transactions and appraisals for loans sold to Fannie Mae and Freddie Mac are not federally related transactions. However, Fannie Mae, Freddie Mac, HUD, and the VA require the use of state-certified or state-licensed appraisers for all loans with which these entities are involved. Regardless of the amount of the loan, it is a violation of federal law for a financial institution to seek, obtain, or compensate a person who the institution knows is not a state-certified or state-licensed appraiser for the performance of an appraisal associated with a federally related transaction. Furthermore, it is a violation of federal law for the Federal National Mortgage Association, Fannie Mae, or the Federal Home Loan Mortgage Corporation, Freddie Mac, to knowingly contract for the performance of an appraisal by a person who is not a state-certified or state-licensed appraiser in connection with a real estate-related financial transaction. All appraisals for federally related transactions must be in writing and conform to USPAP. Florida law goes further and requires that all appraisals, regardless of whether the assignment involves a federally related transaction, performed by real estate appraisers and real estate licensees conform to USPAP. Real estate licensees must be familiar with the standards. Failure to do so may subject the licensee to discipline. Florida real estate licensees who are not state-certified or state Licensed appraisers and who perform appraisal assignments are cautioned to get a statement in writing from the client that the appraisal is not associated with a federally related transaction and does not require the services of a state, certified or state licensed appraiser before accepting the assignment. Appraisal certification and licensure. The AQB has established the following classifications of appraisers. Registered trainee appraisers are registered with the DBPR and may perform appraisal services only under the direct supervision of a certified appraiser. Registered trainee appraisers may only accept appraisal assignments from their supervisory appraiser. Licensed appraisers are authorized to issue appraisal reports for non-complex 1-family to 4-family residential units having transaction values of less than $1 million and complex 1-family to 4-family residential units having transaction values of less than $250,000. The DBPR no longer issues licensed appraiser credentials. However, a small number of Florida licensed appraisers continue to hold this category of license. Certified residential appraisers are certified by the DBPR as qualified to issue appraisal reports for residential real property of 1 to 4 residential units, without regard to transaction value or complexity. Certified general appraisers are certified by the DBPR as qualified to issue appraisal reports for any type of real property. The AQB is responsible for setting minimum qualifications for real property appraisers. The requirements include qualifying education, experience, continuing education, and examination. Certified residential appraisers and certified general appraisers must have a bachelor's degree or higher in any field from an accredited college or university. In addition to the college degree or college-level course requirement, appraiser applicants must complete pre-license appraisal education. For information regarding the Appraisal Foundation, the Appraiser Qualifications Board, AQB, the Appraisal Standards Board, ASB, and qualification criteria, visit the Appraisal Foundation's website at www.appraisalfoundation.org. Download the Real Property Appraiser Qualification Criteria at www.appraisalfoundation.org. Select Qualification Criteria, then Real Property Criteria. Price, cost, and value. Cost is the total expenditure required to bring a new improvement into existence plus the cost of the land. A contractor will install site improvements, water, sewer, and so forth, acquire the necessary permits, secure the services of architects, engineers, surveyors, and other professionals, construct the building, landscape the site, market the property, and so forth. The total of these expenditures is called cost. A contractor wants the cost to be less than the price a consumer will pay, and the consumer will pay more than the cost only if the consumer perceives the property's value to exceed its cost. Price refers to the amount of money actually paid in a transaction. Price and value are not necessarily equal. For example, you might purchase a computer for $2,000. Its price was $2,000. However, it may actually command less, or more, than $2,000 in exchange if you were to attempt to sell the computer. Value is the monetary value of a good or a service to many buyers and sellers at a particular time. Value is influenced by economic forces such as supply and demand. Types of value. Each type of value will result in a different estimated value. For example, the subject property will likely have a higher estimated market value compared with liquidation value. For this reason, the USPAP requires that all appraisal reports indicate and define the type of value that was estimated. The types of value real estate brokers most frequently encounter are discussed below. Assessed value is the value established for property tax purposes. Going concern value is the value of an income-producing property or business enterprise, characterized by a significant operating history. It is the type of value estimated when the business will continue in operation, however ownership is being transferred. Going concern value includes intangible assets such as goodwill associated with the business's reputation, recognition of its name and franchise, and customer loyalty. Insurable value is estimated for insurance coverage purposes. It is based on replacement cost, taking into consideration insurance exclusions. Investment value is the value of an investment to a particular investor based on the investor's requirements regarding rate of return, management involvement, risk, and other factors. Liquidation value is the amount a property most likely will bring at a forced or rapid sale. Liquidation value is used for businesses going out of business. It is sometimes used in valuing foreclosed properties and properties subject to tax liens. Salvage value is the amount for which a property's improvements can be sold at the end of the structure's useful life, taking into consideration the cost of removing the improvements. Value in use is the value of a property based on a specified use that may not represent the property's maximum use, highest and best use. For example, Florida's Greenbelt Law, Chapter 193, FS, requires county property appraisers to base the assessed value of agricultural property solely on the land's current use, even though the property may be ripe for commercial development. Additionally, the IRS allows an estate's executor to value the property in the decedent's estate that is devoted to farming or is used in a closely held business based on the property's actual use rather than on its fair market value. See IRS Publication 448, Federal Estate and Gift Tax. Licensees are cautioned that an appraisal based on value and use may have no relationship to the property's market potential. Market value is the consensus of the interactions of many buyers and sellers in a particular market. Market value is the type of value appraisers are most often concerned with. Many recognized definitions of market value exist. The conditions included in a specific market value definition establish market perspectives for development of the opinion of value. Although the conditions may vary from definition to definition, they generally fall into three broad categories: the relationship, knowledge, and motivation of the buyer and the seller, the terms of the sale, cash equivalent, or other terms, the conditions of sale, exposure in a competitive market for a reasonable time before sale. Market value, stated as an opinion, presumes the transfer of a property as of a certain date, under specific conditions set forth in the definition of the term identified by the appraiser. To estimate market value, the appraiser must identify the exact definition of market value and its authority applicable to the appraisal. Market value definitions. Market value is defined by the USPAP, Federal Housing Administration, FHA, federal banking agencies, Fannie Mae, Freddie Mac, and the Internal Revenue Service. Each definition of market value varies somewhat. For example, the Federal Housing Administration's definition of market value, which is used for FHA mortgage transactions, emphasizes the structure's condition. The IRS definition of market value emphasizes the marketplace where an item is commonly sold to the public. The Fannie Mae Freddie Mac definition is most commonly cited because it is used in connection with mortgages that are to be sold on the secondary market. Fannie Mae, Freddie Mac. Fannie Mae and Freddie Mac define market value as the most probable price that a property should bring in a competitive and open market under all conditions requisite to a fair sale, with the buyer and the seller, each acting prudently, knowledgeably, and assuming the price is not affected by undue stimulus. Implicit in this definition is the consummation of a sale as of a specified date and the passing of title from seller to buyer under conditions whereby buyer and seller are typically motivated, both parties are well informed and well advised, and acting in what they consider their best interests. A reasonable time is allowed for exposure in the open market. Payment is made in terms of cash in US dollars or in terms of comparable financial arrangements, and the price represents the normal consideration for the property sold, unaffected by special or creative financing or sales concessions granted by anyone associated with the sale. Principles of value: supply and demand. All price and value forces have their effect through supply and demand. Supply is the amount and type of real estate available for sale or rent at different price levels in a given real estate market. The variables that influence supply are listed in the text box that follows. Variables that influence supply: availability of skilled labor, availability of construction loans and financing, availability of land, availability of materials, availability of skilled labor. Numerous skilled laborers, such as carpenters, roofers, and electricians, are required for construction. The availability and cost of labor depend on such things as unemployment rates, skill levels required, and the influence of foreign labor. When an area is growing rapidly, the growth usually is characterized by much construction with resulting high employment in the construction industry. These conditions cause competition for labor and its cost increases. Availability of construction loans and financing. New construction is directly related to the availability of construction loans and short-term financing. As money becomes more available and less expensive, more speculative homes will be built, increasing the available supply of housing. The same is true for commercial development. Availability of land. Although land seems physically plentiful, the supply of the type and location of land most in demand is always scarce. Two factors influence the availability of land. 1. The scarcity of readily usable land, and 2. The regulations affecting its use and cost of development. Availability of materials. The availability of construction materials influences the supply of new housing. In the late 1990s, the construction industry nationwide was severely crippled by a shortage of drywall. Drywall couldn't be found anywhere. New construction was stalled, and construction costs spiraled. Demand is the desire and ability to purchase or rent goods and services. In real estate, demand is the amount and type of real estate desired for purchase or rent in a given market at a given period of time. The variables that influence demand are listed in the text box that follows. Variables that influence demand: price of real estate, population numbers and household composition, income of consumers, availability of mortgage credit, consumer taste or preferences. Price of real estate. There is an inverse relationship between price and the demand for real estate. When prices rise, demand goes down. When prices decrease, demand goes up. Population numbers and household composition. The demand for dwelling space depends on both the population and composition of households in every market area. Mere population size does not provide sufficient information for accurately estimating the demand for dwelling space, nor does a count of households. Modern lifestyles, changes in economic conditions, and reduced family size have caused the household to become the basis for most population analysis. A household, as defined by the U.S. Census Bureau, is any person or group of persons occupying a separate housing space. Thus, a household may be a single person living in a rented apartment, a married couple with 4 children living in their own home in the suburbs, or 2 unmarried adults living in a condominium near the city center. Each constitutes a household. Just before the end of the 19th century, 100 dwelling units housed 490 people. Due to the average size of households at that time, 4.9 persons, the most recent census reveals that the decreased size of the average household, about 2.58 people per household, requires approximately 190 dwelling units to house 490 people. The change in average household size alone has therefore caused a 90% increase in demand. Those who study population trends believe that a further reduction in average household size will occur. This again will change the demand for housing, not only in numbers of units but also in size of dwellings. Demographics refers to the characteristics of the population, age distribution, family size, and population movements. Demographics affect not only the total demand for real estate but also the type of housing demanded. The 2010 U.S. Census is available at www.census.gov/2010 census. For valuable information on economic indicators, visit www.census.gov. Economic indicators, data concerning construction spending, new home sales, and housing starts are updated regularly. Income of consumers. Whereas change in price is inversely related to change in demand, income is directly related to demand. As individual income increases, so does demand for dwelling space. Any change in local employment numbers or salary wage levels causes a change in demand for dwelling space and related loan considerations. Availability of mortgage credit. The availability and cost of mortgage credit has been called the barometer of the real estate market. Because the typical purchase of residential property involves 2 or 3 times the buyer's annual net income, it is easy to understand why a large number of homebuyers use credit to arrange the purchase. If a potential homebuyer can afford the monthly mortgage payments, principal and interest, plus property taxes and hazard insurance, the total cost of the house is of secondary importance. The amortized principal portion of a monthly payment can be increased or decreased by 1. The amount of the down payment made on the property, and 2. The term of the loan. Both of these have a direct bearing on demand for housing. When a tight money market develops and interest rates rise, a corresponding drop is reflected in housing demand because the amount of money needed to make monthly mortgage payment increases. For example, a $90,000 mortgage loan at 7% interest for a period of 30 years requires a monthly payment of $598.77, not including taxes and insurance. The same amount of money for the same period but at 9% interest requires a monthly payment of $724.16, an additional $125.39 per month. An increase in mortgage interest rates of even 1% causes a definite drop in demand for housing. Consumer tastes or preferences. Another factor related to demand concerns changing consumer tastes or preferences. Different architectural designs are sometimes introduced into the residential market and may enjoy brief periods of popularity. Generally speaking, however, enduring changes in consumer tastes occur slowly, over extended time periods. In recent years, the green movement has consumers preferring energy-efficient homes. Whatever style and type of house the buying public prefers at a given time is the type of dwelling that will be built more often than others, until a new demand creates a new preference. Changes in demand for condominiums or second homes for vacation purposes also reflect changes in consumer preferences. For years, empty nesters, those parents whose children are grown and have moved away, continued to live in the same house where they had reared their children, although it was then entirely too large for their needs as a couple. The numerous chores of the homeowner related to maintenance, repairs, and grounds upkeep were often a joy but sometimes too physically demanding. The advent of condominiums and other forms of smaller, maintenance-free housing units offered a solution to these empty nesters and other small families. Anticipation. The principle of anticipation is based on the premise that expectation of future benefits creates value. This is the underlying theory of the income capitalization approach to value. The anticipated, projected income that a property will produce during the coming year is capitalized into present value. The value of residential property is based on the perceived benefits from the amenities and quality of lifestyle. A property's value as of a certain point in time is not based on its original cost of production or sale price history, but on what consumers consider its value to be, based on perceived future benefits. Appraisers therefore must be aware of consumer preferences and their anticipation of the future. Substitution. The principle of substitution holds that when several goods or services offering similar benefits are available, consumers tend toward the one with the lowest price. Therefore, property values tend to be set when consumers acquire equally desirable substitute properties. Value then may be estimated from prices paid for these similar properties. This is the premise of all three approaches to value. See also Unit 7. The sales comparison approach is based on the theory that a knowledgeable purchaser would pay no more for a property than the cost of acquiring an acceptable substitute property. The cost appreciation approach is based on the theory that a knowledgeable purchaser would pay no more for a property than the cost of acquiring an equally desirable site, combined with building an acceptable substitute structure. The income capitalization approach is based on the theory that a property tends to be related to its competitive position among alternative, substitute investment choices producing equivalent investment returns and risk. Increasing and decreasing returns. The principle of increasing and decreasing returns states that when one or more factors of production are increased while others are held constant, output, in terms of physical units, dollar return, or other benefits, may increase up to a certain point. However, beyond some point, each additional unit of consumption adds less and less to satisfaction or total utility. At some point, if a homeowner puts too many improvements into a home, the homeowner will not recover the capital invested. The home is said to be overimproved. An overimprovement occurs when more money is invested in a structure than the owner can reasonably be expected to recapture. Appraisers adjust for overimprovements in the cost approach by deducting functional obsolescence from the cost of improvements. The relationship between cost and value added also is important in the sales comparison approach. When determining the amount of dollar adjustments between comparable properties and a subject property, as long as money spent on improvements, for example, additional square feet or bedrooms, produces a proportionate increase in income or value, the law of increasing returns is in effect. Conformity. The principle of conformity suggests that property values are maximized when architectural homogeneity and uniformity of land use occur in a neighborhood, in both residential and non-residential markets. Significant departure from the typical architectural style, size, and amenities of the surrounding area often leads to an adverse market reaction. Consider, for example, a retirement subdivision composed of approximately 101,000 square foot to 1,200 square foot ranch-style homes with white tile roofs. A single geodesic domed residence sits among the other homes. Absurd, you may think, but such examples do exist. Properties that deviate greatly from the market norm are not accepted, and their values are reduced, compared with other more conforming properties. Therefore, from the appraiser's viewpoint, a major concern is whether improvements are typical for the neighborhood. External economies and diseconomies, factors that result from market forces external to a property, can have a positive or negative impact on value. Because real estate is fixed in its location, it is subject to many external influences. External economies result from positive external factors that enhance property values, such as infrastructure to a site, roads, bridges, sewer and water, police and fire protection, and so forth. When comparing two neighborhoods, an appraiser may have to consider, for example, the market effect of a natural gas line to one of the neighborhoods, even when the gas line is not connected to a particular home. If hookup is available, the typical consumer may place value on the natural gas's availability. Similarly, a local city government's decision to target a portion of the city for revitalization, providing low-interest loans for redevelopment, positively affects the property values within the targeted area. External diseconomies have a negative impact on value. External diseconomies result when the actions of people external to a property impose costs on others, such as the cleanup cost of pollution, neighborhood crime, and so forth. External influences affecting value can be found at national, regional, city, and neighborhood levels. Highest and best use. The principle of highest and best use states that the values of sites and properties are maximized when the real estate is used most efficiently. Highest and best use is the probable and legal use of real property that is physically possible, defendable, and financially feasible and that results in the highest value. An appraiser must consider two types of highest and best use. 1. Highest and best use of a site as though vacant, and 2. Highest and best use of the property as improved. The USPAP requires the appraiser to consider the effect of the real property's highest and best use and to recognize that land is appraised as though vacant and available for development to its highest and best use, and the appraisal of improvements is based on their actual contribution to the site. The highest and best use of the site as though vacant is the legal, permissible use of the site that would produce the greatest value. It is a site's potential highest and best use that determines its value. Highest and best use of a site as though vacant asks the question, if the site is, or were vacant, what type of structure or other improvement should be erected? When a site has existing improvements, its highest and best use of the site as though vacant may differ from the existing use. Assume, for example, that a site is improved with a 20-year-old single-family home. The land is zoned for professional offices, and the properties on either side of the subject property are improved with professional office suites. If the subject site were vacant, the use that would generate the highest return to the site likely would be a professional office building. It is not economically feasible to demolish the existing residence, however, unless and until the vacant land value in its highest and best use exceeds the total value of the property in its current use. To select a single highest and best use among alternative income-producing uses, an appraiser analyzes each use in terms of its potential rate of return and perceived income stability. Assume that an appraiser evaluates a vacant site zoned for a commercial strip unit. Developed properties in the surrounding vicinity indicate that the site could be developed as either a small retail center of specialty shops or commercial office suites. To determine which use is the site's highest and best use, the appraiser estimates the development costs, projected net operating income, and overall rate of return under each alternative use, taking into account income stability from each. See highest and best use as the vacant in this case. Specialty retail is the highest and best use because it results in the greater residual land value, $140,900, and requires the smaller outlay of development monies, $450,000. Note that various uses usually result in differing overall capitalization rates, which the appraiser derives by analyzing competing properties. The highest and best use of a property as improved pertains to how the property with existing improvements should be used, rather than what use should be implemented for a vacant site. Highest and best use as improved therefore concerns whether the existing improvements should be maintained in their current state or whether they should be altered in some way to make them more valuable. In most cases, the existing improvements should continue to occupy the site, even though they may not maximize fully the site's potential. When conducting a highest and best use as improved analysis, an appraiser considers various alternative uses for an existing structure, some of which may require modifications to the improvements. The appraiser also must consider demolition of the existing structure and new construction. This alternative, however, typically is economically feasible only when the structure is nearing the end of its economic life. To determine the highest and best use of an improved property, an appraiser estimates the total acquisition costs of obtaining each alternative use and the income projected from each use. Operating expenses are deducted to derive estimated net operating income, NOI, for each use. The appraiser then divides the NOI by the total cost of acquisition and alterations to derive the rate of return. The use that produces the highest rate of return is the highest and best use of the property as improved. When considering demolition, the appraiser estimates the net income to be earned from the new improvements and the rate of return on the total costs of demolition and new construction. For example, assume that an appraiser has been asked to evaluate a large 5-bedroom, 40-year-old house located 2 blocks from a major state university. The neighborhood at one time was well kept and occupied by college faculty. Over the years, however, most of the homes have been rented to college students. Today, less than 10% of the homes are owner-occupied. The appraiser estimates that the property can be acquired for $100,000. Analysis of market rents in the area indicates that the structure could generate $600 in monthly rent as a single-family home. An alternative use would be to rent the 5 bedrooms to college students, who would share the common living room and kitchen facilities. The appraiser estimates that market rent based on the shared living plan would generate $900 per month. $180 per bedroom. Another alternative would be to demolish the house and build a new 4-unit apartment building. The estimated market rent for college apartments is $550 per month, or $2,200 per month for the 4-unit structure. Highest and best use as improved indicates that at this time, the highest and best use of the property as improved is a shared living arrangement. Note that the new apartment unit would produce the greatest NOI. However, the larger net operating income does not offset the cost of demolition and new construction. Expenses of $1,000 have been estimated for the shared living used to cover lawn maintenance and miscellaneous expenses not associated with the single-family rental use. Estimated expenses of $4,000 for the new apartments takes into consideration higher maintenance costs of individual kitchens and mechanical systems for each apartment and higher property management fees. Also note that a collection loss of 10% was estimated for this market. The rate of vacancy and collection loss is market-derived, and with a student rental population, it tends to be higher than it is for other markets due to greater turnover, graduation and transfers, and vacancies. Summer term, for example. The appraisal process. Steps in the appraisal process identify the problem to be solved, including identifying the client, intended users, and use of the appraisal. Determine the scope of work necessary to develop a credible appraisal. Develop the appraisal according to the scope of work. Step 1. Identify the problem to be solved. An appraiser must properly identify the problem to be solved to determine the appropriate scope of work. An appraiser must identify and consider the client, any other intended users, and the intended use of the appraiser's reported opinions and conclusions in order to identify the problem to be solved and to understand the development and reporting responsibilities in an appraisal or appraisal review assignment. Identify the client. The client is the party or parties who engage, by employment or contract, the appraiser in a specific assignment. In instances where the client wishes to remain anonymous, the appraiser must still document the identity of the client in the work file but may omit the client's identity in the appraisal report. When the identity of the client is withheld from the report must state that the client's identity has been withheld at the client's request. Identify the intended user, S, of the appraisal report. The client and any other party are identified by name or type as users of the appraisal based on communication with the client at the time of the assignment. If identification by name is not appropriate or practical, the appraiser may identify an intended user by type. Parties who receive a copy of an appraisal or appraisal review report as a consequence of disclosure requirements applicable to an appraiser's client do not become intended users of the report unless they were specifically identified as intended users by the appraiser at the time of the assignment. Identify the intended use of the appraisal. The intended use of the appraisal report is identified by the appraiser based on communication with the client. Identification of the intended use of the appraisal helps the appraiser determine the appropriate scope of work for the appraisal development process and the level of detail to provide in the appraisal report. Step 2. Determine the scope of work necessary to develop a credible appraisal. The scope of work is the type and extent of research and analyses in an appraisal assignment. Appraisers have broad flexibility and significant responsibility in determining the appropriate scope of work for an appraisal assignment. The appraiser must be prepared to demonstrate that the scope of work is sufficient to produce credible assignment results. The scope of work includes the extent to which the property is identified, extent to which tangible property is inspected, type and extent of data researched, and type and extent of analyses applied to arrive at opinions or conclusions. Whether the scope of work is considered acceptable is determined by the expectations of parties who are regularly intended users for similar appraisal assignments and what an appraiser's peers would do if performing the same or similar appraisal assignment. Step 3. Develop the appraisal according to the scope of work. To develop the appraisal, the appraiser must identify information that provides the basis for determining the type and extent of research and analyses to include in the development of the appraisal. Communication with the client is necessary in order to establish the required information. However, the identification of the subject property's relevant characteristics requires the appraiser's judgment and experience. The appraiser must include in the report sufficient information to allow intended users to understand the scope of work that was performed. Identify client and other intended users. See also Step 1. Identify the intended use of the appraiser's opinions and conclusions. See also Step 1. Type and definition of value. Value is the monetary relationship between properties and those who buy, sell, or use those properties. There are many types of value. The appraiser must identify and define the type of value sought in the assignment. The effective date of the appraisal SPAP requires the appraiser to indicate the date of the report, usually the signature or inspection date, and the value estimate's effective date. The effective date establishes the context for the value estimate. For example, an appraisal for inheritance tax matters may require a retrospective appraisal, that is, a value estimate before the date of the report. An appraisal for the proposed development of a shopping center requires a prospective appraisal, that is, a value estimate effective after the date of the report. The effective date of a residential property appraisal usually is the date of inspection, at which time the appraiser measures the structure and observes its condition. Identify the subject property and the property's relevant characteristics. The subject property has both physical and legal characteristics. Relevant property characteristics include the following: the subject property's location and physical, legal, and economic attributes, the real property interest to be valued, the value associated with a leasehold interest or a life estate in a condominium unit, for example, differs from the fee simple estate interest in the same condominium unit, personal property, trade fixtures, or intangible items that are not real property but are included in the appraisal, any known easements, restrictions, encumbrances, leases, reservations, covenants, contracts, declarations, special assessments, ordinances, or other items of a similar nature, fractional interest, physical segment, or partial holding. The rights might be owned in part, as a fractional interest, or in full. Additionally, real estate can take many forms, such as land and improvements, or improvements without the underlying land. It also is possible that the valuation concerns only a fractional interest in the real estate, such as the subsurface rights. Therefore, the property rights to be valued are critical to the value conclusion. Extraordinary assumptions and hypothetical conditions necessary in the assignment. The appraiser considers any extraordinary assumptions and any hypothetical conditions necessary in the assignment. If an appraiser cannot verify a certain condition that is critical to the valuation, but which the appraiser has a reasonable basis to accept as true, the condition is an extraordinary assumption. Example: the appraisal of proposed improvements, such as new construction, is an extraordinary assumption if it is reasonable to assume the plan for the proposed improvements when conducting the appraisal assignment. When appraising proposed improvements, the appraiser examines plans, specifications, and other documentation sufficient to identify the extent and character of the proposed improvements. Example: if an appraiser is asked to value irrigated farmland on the premise that the water supply is adequate for irrigated crop production, absent any evidence that the water supply is not adequate, the appraiser would identify in the appraisal report the adequate water supply as an extraordinary assumption. If, on the other hand, an appraiser is asked to use a condition the appraiser knows is false, but which is necessary for the analysis, a hypothetical condition is used. False conditions are called hypothetical conditions. Hypothetical conditions are contrary to known facts about physical, legal, or economic characteristics of the subject property on the effective date of the valuation results. What makes the condition hypothetical versus extraordinary? Let's revisit the previous examples and determine what might make the conditions hypothetical assumptions. Example: the appraiser is asked to appraise proposed new construction as of a current date, when the improvements do not exist today. The appraiser knows that the improvements do not exist as of the current date of the appraisal. However, it is reasonable to want to know the value of the proposed improvements as if they exist today. Therefore, this is a hypothetical assumption. Example: assume the appraiser's job is to appraise irrigated farmland on the premise that the water supply is adequate for irrigated crop production. Knowing that the existing supply is not adequate, the client wants to know what the property is worth. assuming an adequate water supply is in place. In this case, the appraiser must identify the hypothetical assumption made in this valuation assignment. A hypothetical condition may only be used in an assignment if the use of the hypothetical condition is clearly required for legal purposes, for purposes of reasonable analysis, or for purposes of comparison, and the use of the hypothetical condition results in a credible analysis. The appraiser must clearly and conspicuously state all extraordinary assumptions and hypothetical conditions used in the analysis and state that their use might have affected the assignment results. Land use regulations, economic supply and demand, and market area trends. The appraiser identifies and analyzes the effect on use and value of existing land use regulations, reasonable probable modifications of such land use regulations, economic supply and demand, and the physical adaptability of the real estate and market area trends. Develop an opinion of the highest and best use of the real estate. The highest and best use as the vacant and the highest and best use as improved are identified. The comparable's highest and best use, as the vacant and as improved, should be the same as the subject property's highest and best use. The appraiser must analyze the relevant legal, physical, and economic factors to the extent necessary to support the appraiser's highest and best use conclusion. See also highest and best use. Collect, verify, and analyze information necessary for a credible appraisal. The information necessary is based on the relevant approaches to value. USPAP requires that appraisers attempt to use all three approaches to estimate value if enough market data are available. If the appraiser does not use an approach in the analysis, the appraiser must justify its omission. When the sales comparison approach is necessary, the appraiser analyzes comparable sales data to indicate a value conclusion. The sales comparison approach usually provides the best indication of market value of residential resale property and vacant sites. When a cost approach is necessary, the appraiser develops an opinion of site value and analyzes comparable cost data to estimate the cost new of the improvements. The appraiser also analyzes comparable data to estimate the difference between the cost new and the present worth of the improvements. Accrued depreciation. The cost depreciation approach is most appropriate when the site value is well substantiated. The improvements are new or nearly new and represent the highest and best use of the site, and the improvements do not suffer from substantial depreciation. This approach is also used for special purpose properties, such as hospitals, community colleges, fire stations, and libraries. When the income approach is necessary, the appraiser analyzes comparable rental data and/or the potential earnings capacity of the property to estimate the gross income potential of the property. The appraiser analyzes comparable operating expense data to estimate the subject property's operating expenses. Comparable data are used to estimate rates of capitalization and/or discount rates. The appraiser must base projections of future rent and/or income potential expenses on reasonably clear and appropriate evidence. When developing income and expense statements and cash flow projections, the appraiser weights historical information, current supply and demand factors, and anticipated competition from developments under construction. Type of value estimated. USPAP requires appraisal reports to identify the type and definition of value and cite the source of the definition. When the opinion of value is to be market value, the appraiser analyzes all agreements of sale, options, and listings of the subject property current as of the effective date, and all sales of the subject property that occurred within the 3 years before the effective date. Reconcile the approaches. The appraiser reconciles the quality and quantity of data analyzed within the approaches used and reconciles the applicability and relevance of the approaches, methods, and techniques used to arrive at a value conclusion. Reconciliation is the process of evaluating and weighing each value indication obtained from the various approaches to value. An appraisal report usually contains 3 indicated values, one from each approach, and the appraiser reconciles these into a final estimate of value. The reconciliation process requires that the appraiser consider each approach's relative applicability and the source of the data collected in each approach. The appraiser must evaluate the data's reliability, choose the approach that best applies to the specific appraisal problem, and select from among the alternative indications the value that best represents the defined value used in the assignment. Assume that an appraiser has applied all 3 approaches to the appraisal of a 2-year-old single-family home located in a neighborhood where the appraiser was able to locate 5 comparable sales. The appraiser believes that the data used in the sales comparison approach are the most reliable because all sales were recent, within 12 months. The same builder constructed all the comparables, Very few adjustments for physical features were made, and all the sales were located in the same subdivision. A location adjustment was not needed. The appraiser also relied heavily on the cost depreciation approach because the home was nearly new and therefore was the property's highest and best use, exhibiting almost no depreciation or obsolescence, and because the developer supplied reliable cost figures. The appraiser was able to apply the income approach because rental data were obtained on 2 homes in the same neighborhood. However, the appraiser gave this approach the least weight because the rental data were limited. About 95% of the homes in the neighborhood were owner-occupied. Final reconciliation summarizes the appraiser's final reconciliation of the 3 approaches. The appraiser could have given all the weight to the sales comparison approach. The decision is subjective, based primarily on the reliability of the data collected and the purpose of the appraisal. In most cases, an appraiser uses reconciliation to blend varying estimates of value from different approaches and comparables into a final estimate of value. Report the appraisal. The type, format, length, and contents of the written appraisal reports varies depending on the requirements of the client and the scope of work criteria. Types of appraisal reports. Appraisals are either oral or written. To the extent possible and appropriate, oral appraisal reports must address the same matters as written appraisal reports. USPAP requires at a minimum that oral and written appraisal reports not be misleading, contain sufficient information to enable the intended users to understand the report, identify the client, unless the client has specifically requested otherwise, and identify the intended users, state the intended use of the appraisal, summarize information sufficient to identify the subject property, including the relevant physical, legal, and economic property characteristics, state the real property interest, property rights, appraised, state and define the type of value, citing the source of the definition, state the effective date of the appraisal, summarize the scope of work used to develop the appraisal, summarize the information analyzed, the appraisal methods and techniques used, and the reasoning that supports the analyses, opinions, and conclusions. Exclusion of the sales comparison, cost, or income approaches must be explained. State the use of the real estate at the date of value and the use of the real estate reflected in the appraisal, if an opinion of highest and best use was developed. Summarize the rationale for the opinion of highest and best use. State all extraordinary assumptions and hypothetical conditions, and how the assumptions and hypothetical conditions might have affected the assignment results, and include assign certification. 2 written report options. The 2 written report options are as follows. Appraisal report. When the intended users include parties other than the client, an appraisal report must be provided. Restricted appraisal report. When the intended user is exclusively the client, a restricted appraisal report may be provided. A restricted appraisal report must include at or near the beginning of the report a prominent use restriction that limits the use of the report to the client and warns that the rationale for how the appraiser arrived at the opinions and conclusion in the report may not be properly understood without additional information in the appraiser's work file. The essential difference between appraisal reports and restricted appraisal reports is the content and level of information provided. In an appraisal report, specific parts of the research and development must be summarized, whereas in a restricted appraisal report, those same parts are only stated. In an appraisal report, the appraiser must summarize the information analyzed and the reasoning that supports the analyses, opinions, and conclusions, whereas a restricted appraisal report does not have this requirement. The appropriate reporting option and the level of information necessary in the report depend on the intended use and the intended users. Certification. Both appraisal reports and restricted appraisal reports must contain assigned certification in compliance with USPAP. The certification states that the appraiser has personally conducted the appraisal in an unbiased, objective manner in accordance with USPAP. Appraisal report formats. Form reports are used by financial institutions, insurance companies, and government agencies. Standardized form reports are required for the purchase and sale of existing mortgages on residential property in the secondary mortgage market. Fannie Mae and Freddie Mac require appraisers to use specific appraisal report forms depending on the type of property and whether the appraisal is based on interior and exterior property inspections or exterior-only property inspections. FHA and VA appraisers must also use the standardized Fannie Mae Freddie Mac report forms. Narrative reports. Narrative reports are written reports that do not use standardized forms.
Important summaries, Unit 6.
Summary of important points. An appraisal is an oral or written estimate or opinion of value of property rights as a specific date based on supportable evidence. The purpose of an appraisal is to determine the problem to be solved and the type of value to be estimated. Appraisers and real estate licensees who conduct real estate appraisals are required to comply with the Uniform Standards of Professional Appraisal Practice, USPAP. Appraisal reports involving a federally related transaction must be in writing and prepared by a state-certified or state-licensed appraiser. The 4 appraiser classifications are: 1. Registered trainee appraiser, 2. Licensed appraiser, 3. Certified residential appraiser, and 4. Certified general appraiser. A comparative market analysis (CMA) is used to assist sellers with establishing an asking price or to assist a buyer with establishing an offering price. A CMA is not an appraisal. A broker's price opinion (BPO) is a written opinion of the value of real property. Florida real estate licensees are allowed to prepare and charge for BPOs, provided the BPO is not labeled as an appraisal. Cost is the total expenditure to create the improvement. Price refers to the amount of money actually paid. Value is determined by what consumers are willing to pay in the marketplace. Market value is the most probable price that a property should bring in a competitive and open market under all conditions requisite to a fair sale, with the buyer and the seller each acting prudently and knowledgeably, and assuming the price is not affected by undue stimulus. Supply is the amount and type of real estate available for sale or rent at different price levels in a given real estate market. Demand is the total quantity of a good that consumers are willing and able to purchase at various price levels over a given period of time. The principle of anticipation is based on the premise that expectation of future benefits creates value. The principle of substitution holds that when several goods or services offering similar benefits are available, consumers tend toward the one with the lowest price. An overimprovement occurs when an owner invests more money in a structure than the owner can reasonably expect to recapture. The principle of conformity suggests that property values are maximized when architectural homogeneity and uniformity of land use occur in a neighborhood. External economies result from positive external forces that enhance property values. External diseconomies have a negative impact on value. Highest and best use is the most profitable use of a property. It is the probable and legal use of real property that is physically possible, defendable, and financially feasible. Reconciliation is the process of evaluating and weighing each value indication obtained from the various approaches to value. The steps in the appraisal process are: 1. Identify the problem to be solved. 2. Determine the scope of work necessary to develop a credible appraisal. 3. Develop the appraisal according to the scope of work. And 4. Report the value estimate. Appraisal reports may be either oral or written. Written appraisal reports are used when the intended users include parties other than the client. If the intended user is only the client, a restricted appraisal report is used. The Fannie Mae Freddie Mac appraisal report form is used by financial institutions, insurance companies, and government agencies. Narrative reports are written reports that do not use standardized forms.